Good afternoon, everyone. Again, this is your Prof. Zeus, and for this afternoon, we'll be discussing about accounting for bonds. Now, what is a bond? Just like a promissory note, a bond is a formal document or instrument, okay, whereby the parties to the bond, which is the bond issuer, is in need of money and is searching or looking for investors in terms of bonds. So therefore, there's another party called the bondholder or the investor, bond investor. So in the normal setting, this is your creditor and this is your debtor. Okay. So the bond issuer promises to pay the bond investor the sum of money that he owes sometime in the future, as indicated in the bond contract, plus of course to pay the corresponding amount of interest as agreed between the two of them. Okay. Now, during the asset section, we've discussed about investment portion, meaning on the part of the investor. On this part, we'll be discussing about the part of the bond issuer. Now, earlier in the previous video, you've learned about the accounting for promissory notes, okay, especially those with interest-bearing or those that are interest-bearing notes. And essentially, we'll be using the same concept, that is the time value of money. So I hope you still recall the time value of money because we'll be using extensively the time value of money in this discussion, okay? So therefore, let's have an example. Let us assume that on January 1, say AEG Corp, okay, floated a 1 million bond, a 1 million, let's say 6% bond, 6% 5-year bond, okay, that pays interest every December 31st. Okay, so let us assume that AEG floated 1 million bond at 6%, 5 years, and it pays interest every December 31st. So the first question here is, how much will the bond investor be or is willing to pay the bond issuer? Because he'll be the one who will be lending money to the bond issuer. So how much is he willing to pay for this 1 million bond? Okay, is he willing to pay 1 million, 1.2 million, or 900,000? Meaning an amount lower than the face value of the bond. Let us assume that the effective interest rate is, say, 10%. Again, just like what we did in notes payable, we are going to use what we call effective, and of course, this is what we call the nominal interest rate. Okay? So again, we will be using the concept that we discussed about time value of money and in promissory notes. Okay, like what I encourage you to do, you have to do your timeline for you to find out, okay, what are you going to use in terms of the present value factor. Okay, so assuming this is 1, 2, 3, 4, 5. Now remember, this is a long-term liability, and as such, the maturity of the obligation is on the 5th year. It's a 5-year loan. So this is where the maturity is. So this is the maturity. And at this time, the bond issuer will have to pay the 1 million. Sorry. The issuer will have to pay the 1 million principal. Right? And every December of each year, the issuer will have to pay the 6% nominal interest. Again, this one is what we call the nominal interest. What is nominal interest again? That is the interest that's imprinted or stated or indicated in the bond certificate. Okay? So 1 million. But apart from this one, he also promises to pay the interest of 6%. This is the nominal interest every December 31st. So what is 6% of 1 million? So I guess that's 60,000. So every December 31st, he will have to pay 60,000 pesos. Okay, 60K. Okay, there you go. So you have the timeline and you have the values. Okay, you have 60,000 every December 31st and 1 million at maturity date. Okay, you've seen this before when we discussed about promissory note. So the first thing that we have to find out is the issue price. This is the first issue, no? How much will be the issue price of the bond? And again, we will be able to compute for the issue price of the bond by getting the present value of the principal, which in this case is 1 million, and the present value of the interest. Now, in this case, interest is 60,000, right? So this is 60,000 pesos. Now, as what we have discussed in promissory note and time value of money, we have here in uniform or the same amount of nominal interest. So therefore, in order to expedite the computation of the present value, we have to use the present value of annuity. Let's compute for the present value of annuity using the discount or the effective rate. So that's going to be 1.1 divide. So it's 1, 2, 3, 4, 5. Now, in this case, we will be using the present value of 1 because it's only a one-time transaction. So, therefore, present value of 1 million, present value factor of 1 million, okay, at 10% is 0.6209. Try it, guys. Let us try it again. So, 1.1 divided by 1, 2, 3, 4, 5. Okay, 6209. So therefore, minus 1 for us to get the annuity divided by 0.10. So this will be 3.9, 3.7907. Okay? So we have here now the present value factor for 1 and the present value factor for an annuity. Okay, for an annuity. So let us now compute. So this is 620,900. While the other one is 60,000 times 3.7907. So this is 227,442. So therefore, plus 620,900. So this is 848,342. So this is now the issue price of the bond. Now, what can you say about this one? Okay? So therefore, the issue price of the bond is lower than the principal amount of the bond because the principal amount is 1 million. And the difference is how much? So minus 1 million, 151,658. Okay, so this is what we call, as what we have discussed, in notes payable, discount on bonds payable. Okay? Now, why is this so? Because if you look at the interest rate, the bond issuer is willing to pay just 6% interest, right? While others issuing the same type of bond is willing to pay 10%. And so therefore, it's going to be very difficult for him to attract investors because he's paying less. So in order for the investors to be attracted to buy his bonds, he will have to sell it at a discounted price of 848,000 because the investor will also have to make up for the lost interest of 4%. That's 10 as against 6%. Okay? Now, just like what we have discussed in notes payable or accounting for promissory notes, okay? The discount on bonds payable will eventually be amortized. So, what are we going to do with this one? We are going to amortize this using the effective interest method. Okay, since this is a bonds payable, so therefore this will be what? Offset or added back to interest, added to the interest income, depending on whether it's a discount or a premium. Okay? So therefore, one general rule or one generalization we can make is if the nominal rate is lower than the effective rate, then the instrument will be issued at a discount. But if it's the other way around, this is 6 and this is 10, then the bond issuer can what? Can price the instrument at a higher price because he's paying more interest so that, compared to other players or other issuers of bond in the market. Okay? Now, how are we going to record this transaction? So we have already solved the first issue with regard to accounting for bonds, and that is the issue price. Okay? So are we going to record the transaction? I'll just erase this one. Okay, so therefore, debit cash. How much is he going to receive? That's 848,342. And then credit your bonds payable for the principal amount of 1 million. Now, if you would notice, credit is greater than the debit. So therefore, we're going to have another debit, and that is the discount. So discount on bonds payable. That is 151,658. So this is how you will record the issuance of the bonds, okay? And so therefore, since we are going to amortize the discount, we are going to prepare our amortization table. Let's do this. Okay, so again we have the date, okay, and then we have the interest expense, and then we have the interest paid, and then the difference between the two is your amortization, and then we have the carrying value of the bonds. Okay, so this is how our amortization will look like. The date and then the interest expense, which is equal to the carrying value of the obligation multiplied by the effective interest rate. Now, interest paid is equal to the nominal rate, okay, the nominal interest, sorry. And then amortization is the difference between the two, and then the carrying value of the obligation. So this is January 1, and the carrying value of the obligation is 848,342. Now, just like the concept I relayed to you when we were discussing about notes payable, the objective of the amortization is to bring the carrying value of the obligation to its what? To the principal amount. Because remember, at the end or at the maturity of the obligation, what the issuer promised to pay the bond holder is that he will pay the principal amount. So therefore, at the end of the 5th year, this should be equal to 1 million. Okay? That should be equal to 1 million pesos. Okay? So let's do this. So on December 31, on the 1st year, okay, we will now have, so the interest expense is 848,342 times 0.10. So that is 84,834. While the interest paid is how much? That would be 6%, so that's 60,000 pesos. So 84 minus 60, that is your amortization. So 84,834 minus 60,000. So therefore, amortization now is 24,834. Now, we are going to add, because as I said earlier, the objective is for us to bring this to 1 million pesos. Okay? So this is lower, so we have to add 24,000 plus 848,342. So this becomes 873,176. Okay? Now, another year end, December 31. Okay, so that will be 0.010. 0.10. So this would be 87,318 as against 60,000 pesos. So this would be 27,318. So therefore, So minus 60,000 plus 873,176. So this now becomes 900,000, 495. 27,318 plus 873,176. Sorry, 494. Okay, then again, December 31. Okay, times 0.10. So that would be 90,049 as against 60,000. So therefore, this is less 60,000. 30,049. So this is now the amortization for the third year. Again, we added to 900, 494. So this is 930,543. Okay? Then on the fourth year, December 31, again times 0.10. So this is 93,054 as against 60,000. So therefore, minus 60,000, we will get 23,054. Add this to 930,543. So this will be 963,597. Let's check. 930,543 plus 23,054. Okay. And then on the last year, last December 31st, okay, times 0.10. This is 96,360 less 60,000 nominal interest. So less 60,000. Therefore, this is now 36,360. Okay, so again, there's a little difference. Plus 26,360. Okay, we have a difference of how much? Less 1,043 pesos. So what we're going to do is, we will just adjust the interest, okay? So this should be 1 million pesos. And so therefore, this should be, okay, 963,597 minus 1 million. This should be 36,403. And so therefore, this is 403. Okay, so guys, this is now our amortization table for this problem. Okay, so what are we going to do? Every December 31st, the company will have to prepare two entries. One is to recognize the payment of the interest, which is actually this one. Okay, so this is the amount of interest that they will have to pay. And then recognize this, the amortization, sorry. Recognize the amortization every December 31st. Okay, again, through interest expense. So how are we going to, what will be the entry on every December 31st? Let us just write on this, okay. Okay, let's just write it on this side. So therefore, let's move this one. Let us adjust this one. Okay, so therefore, on December 31, what are we going to do? First, do the entry for the payment of the interest. Then with interest expense, for how much? 60,000. And credit cash for 60,000 pesos. Okay? And then, like what I said earlier, now we have to recognize the amortization of the bond discount. Okay? So therefore, the bond discount is a debit balance account. So therefore, to decrease that, we have to credit the discount. So then credit discount on bonds payable, and the debit would also be interest expense. For how much? The first one, 24,834. 24,834. Okay? So, what have we noticed? So amortization of the discount increases the interest expense. So if you would see in your amortization table, guys, The real interest expense is this one, which is the effective interest. So if the question is, how much is the interest expense? Your shortcut would be the carrying value of the obligation multiplied by the effective interest rate. Okay, that would be your procedure. Okay, so therefore, there you have it, guys. This is the first issue on bonds, okay, or example for bonds. There are various scenarios that we can think of, like say for example, in this case, this is an annual payment of interest. Now, what if the payment of interest is every June 30 and December 31st? So therefore, what are we saying here? The interest is being paid semi-annually. So how will this affect our computation? Now, if you're going to go back to our computation earlier on the issue price of the bonds, what we're going to do is what? Just divide this one, since it is by semi-annual, divide this by 2 and also divide this by 2 and multiply the periods by 2. Okay? So, shall we do it? Okay, let's do it. Sorry. Okay, let me erase this one. Okay, so if you're going to draw a timeline, okay, so the timeline is what? Every six months they pay interest. Second year, third year, fourth year, and then fifth year. Okay? So that's how your timeline would look like. Okay, so therefore, this is 1 year, 2 years, 3 years, 4 years, 5 years. Okay, so again, at the end of the at the end of the term of the bond, let us adjust this one. Okay, so at the end of the life of the bond, again, the bond issuer will have to pay 1 million pesos. But every 6 months, he will have to pay what? The nominal interest. Okay, so therefore what we said earlier was that you have to divide this by 2. So therefore it will be 3%. So 3% of 1 million, that's going to be 30,000. So every 3 months or 6 months, the bond issuer will have to pay 30,000. Okay, so this is how your timeline will look like. So every 6 months, they will have the issuer will have to pay 30,000, and at the end of the term, which is in the 5th year, he will have to pay the principal amount of the obligation. So how will this affect our computations? Again, we just have to find the present value. Okay, present value of the principal and present value of the interest. Okay, so present value of the principal is 1 million pesos. And then present value of the interest is 30,000. Okay, again, what type of present value factor are we going to use? Now, this one, we will be using present value of 1. While this one, we will be using the present, this one. Okay, these are uniform cash flow, so we will be using the annuity. Okay, let's compute for that. Present value factor. Okay, so therefore, this is 0.6139 minus 1 divided by 0.05. So this is 7.7217. Okay, so let us now compute. So this is 613,900. And then 30,000 times 7.7217. This is 231,651. Okay, so plus 613,900. So this is 845,551. Okay? So this is now our issue price. So this is the issue price of the bond. And so therefore, comparing that with the principal amount of the obligation, which is 1 million. So therefore, minus 1 million. So this is 154,449. Now this is now your discount. This is now your discount on bonds payable, which you have to amortize over the term of the bond. You can use the amortization table I have presented earlier in order to amortize this discount. Okay, so this is the simplest example for bond transactions. Okay, it can be complicated, no, as we go along. Okay, so this is it for now. I'll see you again on the next video. Thank you very much for watching, and please do watch my other videos, and you can click the subscribe button and the bell for you to be notified whenever I upload another video. Okay, thank you very much guys, and see you again. Bye.